Hi, Assalamualaikum. My name is Nur Azira. So I'm going to explain about the definitions of cost and cost-based pricing. So cost is the amount that it takes for a company to purchase the product it sells. There are two types of costs, which is direct cost and indirect cost. For direct costs, it tends to be a variable cost. For example, direct labor and direct materials. For indirect costs, it is likely to be either fixed or period costs. For example, quality control, insurance, and depreciations. Next definition is cost-based pricing. Cost-based pricing set price based on the full cost of a product plus margin or premium. What does it mean by premium? This premium covers any costs that are not included in the full cost, such as interest expenses and return on investment (ROI). In this slide, I'm going to explain about the characteristics of cost-based pricing. So there are 5 characteristics of cost-based pricing. The first one is product. You need to differentiate your product from your competitors. Always think of the latest trend and latest technology gadget so that it can fit to your customer demand. The second one is cost. Every product must have costs related to it. By looking at the cost first, you can consider how high the price that you can charge to the customer. The third one is price. You need to set your price on that particular level where you can maximize your profit. The lower the price, the higher the demand will be. The fourth one is value. Customers perceive high level of product value. It is seen as the satisfaction that the customer can get from the product that they purchase. They will buy again if they perceive to be getting high value from the product. The last one is customer. Without customer, the product that you are selling is nothing. All the price setting and promotion will be according to your target of customer. So in this slide, I'm going to explain about the factors to consider before selecting the strategy. There are 2 factors, which is internal factors and external factors. So first, I'll start with the internal factors. The first internal factors is the objective of the firm. The firm may have various objectives, and pricing contributes its share in achieving such goal. Therefore, pricing policy or pricing strategy should only be established only after a proper considerations of the objective of the firm. Second one is the cost of the product. A business cannot ignore the cost of production or buying a product when it comes to setting a selling price. In long term, a business will fail if it sells for less than cost, or if its gross profit margin is too low to cover the fixed cost of the business. The third one is organizational factors. Pricing decisions occur on 2 levels in the organizations. Overall price strategy is dealt by top executive, while the actual mechanic of pricing is usually dealt by lower levels and more focused on individual product strategies. So the fourth one is product differentiations. The price of the product also depends upon the characteristic of the product. In order to attract the customer, you need to customize the product based on their demand so that it can attract their attentions and their willingness to buy the product. The second factor is external factor. So for the first external factors is the demand. The market demand for a product or service obviously has a big impact on pricing, since the demand is affected by numbers, the source of competitors, prospective buyers, and their capacity, and other minor factors that can affect the customer demand. The second one is the competitions. Competition conditions affect the pricing decisions. In order to set your selling price, you have to look at your competitor's selling price so that you can set your price either the same, or maybe your price can be lower than their price. So the third one is supplier. Supply of raw materials and other goods can have a significant effect on the price of a product. For example, if the price of cotton is increased, therefore the selling price that you are going to charge your customer will also be increased. And the last external factors is the economic conditions. The inflationary or deflationary tendency affects pricing. Usually in recession period, the prices are reduced to a sizable and extend to maintain the level of turnover. On the other hand, the prices are increased in boom period to cover the increasing cost of productions and distributions in order to meet the changes in demand, price, and others factors.
I'm going to talk about why product costs need to be considered. The cost of the product cost is including the amount spent on product development, testing, and packaging required have to be taken into account when a pricing decision is made, and so do the costs related to promotion and distribution. Customer price sensitivity. Three important factors are whether the buyers perceive the product offers value, how many buyers there are, and how sensitive they are to change in price. Price elasticity or people's sensitivity to price change affect the demand for products. Elasticity refers to the amount of stretch or change. Similarly, or the demand for a product may change if the price change. Company goals. Company or business goal are part of a larger process that starts with the vision and mission of our company and ends with specific goals. Objective and action plans that helps us move our business forward. How competitors price and sell their products will have a tremendous effect on a firm's pricing decision. Because company want to establish and maintain loyal customers, they will often match their competitors' price. Economic. When the economic is weak and many people are unemployed, companies often lower their price. The marketer also have to consider the economic condition prevailing in the market while fixing the price. Legal and regulation. Legal and regulation are designed to protect consumers, promote competition, and encourage critical and fair behavior by business. Other reasons such as channel intermediary. The marketer must consider a number of channel intermediary and their expectation. The longer the chain of intermediary, the higher would be the price of the goods.
So today I will explain about the price optimization software, and it can be defined as the use of the mathematical analysis by a company to determine how customer will respond to different prices for its product and service to different channels. And the function of the price optimization software is to tailor pricing for customer segment by stimulating how target customer will respond to the prices changes, and next to collect historical data and monitoring result with the upgrade data input, and also by improve the modeling accuracy. Lastly, to clarify the business value proposition by set strategy rules to guide the modeling accuracy. So I will explain about the types, and it's a 4 types of price optimization software. Firstly is the merchandise pricing. It has a positive effect on businesses, not more than 150 retailer worldwide using this merchandise pricing. For the example retailer that using this merchandise pricing is the Walmart store. Next is the markdown optimization. Is being used to determine what to put on sale and at what discount. It is often used by clothing retailer because the software tend to recommend putting things on sale sooner in hope it can moving the product more faster. Third is the price setting. Software will make the store more efficient and savvy at promoting precisely what consumer want. This also gives store managers support for raising prices. Lastly, the price optimization has the ability to calculate a large degree of variable more efficiently than human. Hence, it will take the store data and predict how much of something will sell at a given prices. It will hunt for items that correlate with each other. For the strength, I will explain the strength first. Is the repeat immediate financial benefit. It provide opportunity to concentrate on various goals, whether it is margin or the amount of sale convention. In addition, it working in parallel with category, which is with the help planning the optimization of prices. The prices of the method will be allocated to specific pricing strategy, and additionally, they will be put to work automatically. Therefore, it speed up how quickly decisions are being made. For the witnesses, it is possibility of large-scale unemployment in different market sector due to automation. As more and more company automate in order to increase protection efficient, so that the workers are disenfranchised. Lastly, is the job losses may contribute to the financial insolvency, and this can also affect the overall health of the economy.
Assalamualaikum to Cikgu Arman. Today I will present my slide about cost plus pricing. Firstly, I will give a definition of cost plus pricing. The definition of cost plus pricing is the method of the price where the sale price of a product determined by increasing the profit margin to the product cost per unit. Next characteristic of cost plus pricing is, first, they create a profit margin, secure margin by fixing markup price, get the margin, and easy to calculate a large number of product. Next, the reason why cost plus pricing is using is this type of price is easily to calculate in particular version of the calculation method. Next, profit is secured by contract in place, and there is a lower risk of a loss pricing method, but is one of the most risky. And lastly, this type of price is quite transparent to customer because it relatively easy for the company to explain how the price is. Okay, next, the step in implementing this strategy is determine the total cost of the product or service, divide the total cost by the number of unit to determine the unit cost, and next multiply the unit cost by the markup percentage. Next, the type of cost plus pricing is, first, pricing product, development context, service, and credit. Next, the sample calculation of cost plus pricing is price equal to cost per unit times by 1 plus profit margin. Next step is price equal to cost per unit plus profit per unit. So we can get the cost plus pricing. Okay, next, the advantage of cost plus pricing is, firstly, simple. Next, assure contract profit and justifiable. Okay, next, disadvantage of cost plus pricing is it one of the most risky method. Ignore competition of other calculation, product of contract cost overrun, and next, ignore replace again cost. Okay, next, markup pricing. The division of markup pricing is pricing strategy in which the price of a product or service to calculate by adding together the cost of the product and the percentage of markup. Next, the characteristic of markup pricing. First, describe the difference between the other price. A percentage of the sale price of as a percentage of the cost. Set price to cover production cost. The reason of the markup pricing is the cost. Firstly, the cost of production. Next, market demand for a product or service. Next, step in implementing this strategy. Firstly, we must calculate all the costs of purchasing and producing the product. Next, and lastly, add the desired markup to it so you can get the answer of markup pricing. Next, the type of markup pricing is, firstly, determine the base price. Next, using markup to determine retail price, and next, markup of course be as profit margin. And next, the calculation to the markup price is markup percent on selling price equal to dollar markup divided by selling price, and you can get the answer of the markup price. Next, the advantage of markup price is allow vendor to easily calculate profit, require a bit of information, as demand and cost may not be available, provide way that price are easily available. Net disadvantage of market price, it provide incentive for inefficiency, include some costs from using only extra costs, and it tend to ignore user growth. Thank you, and I will pass the presentation to my member.
So for the break-even pricing, or as been known as the BEP, is the relationship between cost, volume, and profit at various levels of the activity with an emphasis placed on the break-even point. This point is where the business receives neither profit nor a loss, when total money received from sale equal to total money spent to produce the item for sale. And the characteristic for BEP is there is no loss and profit to the firm. Total revenue will equal to total cost. It indicates the minimum level of production or sale, and it suggests the break-even pricing level, whether profit or loss. The reason for using BEP is to determine the point of profitability. A business that does not turn a profit is one that could take a turn for the worse at any time. This is why every company need to focus on each point of the profitability. They need to consider how much the revenue that they need to generate to cover all the expenses, and therefore they have to think which product or service that generate a profit and which are sold at a loss. It will be easier to target the level of profit with the amount of unit that we produce. Next, to set a price for a product or service that will be produced. In the overall sense, it is good to have a solid understanding of the company break-even point. They need to generate X amount of revenue to break even and begin to turn a profit. They have to examine the final detail, which is means finding the break-even point for pricing a product or service. This is to see whether the price is worth or not. Last but not least, to analyze information to implement the strategy to moving forward. This step they have taken in the past may not be the step taken in the future. It always looking for the opportunity in the way to improve their businesses, such as lowering the out-of-pocket expenses to increase the revenue. In that, they can use a break-even analysis to analyze information when creating a strategy in the future. As a company profitability is determined by the success of one or more product, using the break-even point for each product will provide a timeline for the company. So next I will proceed with the types, and it have three types of BEP. Firstly is the accounting break-even, where the sales volume when net income equal to 0. It is often used as an early stage screening number. If a project cannot break even on an accounting basis, then it is not going to be a worldwide project. This accounting break-even gives manager an indication of how a project will impact the accounting profit. So next is the cash break-even, which is the sale value where its operating cash flow will equal to 0. It shows a firm minimum amount of revenue from sales that are required to provide the business with positive cash flow. Lastly is the financial break-even, the sale value where net present value equal to 0. It is the level of the earning before interest and taxes, which is equal to firm fixed financial costs, which include interest and preferred dividend. Next is the step in implementing this strategy. Firstly is determine the variable unit cost. Determine the variable cost of producing one unit of the product, which is the variable costs are those costs associated with making the product or buying it wholesale. If we are making a product, we will need to know the cost of all the components that go into that product. Next is determine the fixed cost, the cost that to keep the business operating even if you did not produce any product. To determine fixed costs, add up the cost of running the factory for 1 month. These costs will include rent or mortgage, utilities, insurance, salaries of non-production employees, and all other costs. In other words, the fixed costs are all costs of the businesses except the directly related to producing the product. Then determine the unit selling price is for the product, and the price may changes as you see where your break-even point is. Then determine the sales volume, and unit price will change as the volume for this product and the unit price is changed. Lastly is the create a spreadsheet. To do a break-even calculation, you have to construct or use a spreadsheet, then turn the spreadsheet into a graph. This spreadsheet will plot break-even for each level of sale and produce price, and it will create a graph showing your break-even for each of these prices and sales volume. So in the slide, I've shown the calculation, the sample, and for BAP we have two calculations. Firstly is in unit, and second is the in sale. So both have the different formula, but it will be easier for you to use that formula. Last but not least, I will explain about the advantage and disadvantage. So first, I will explain the advantage first. The main advantage of a BAP is that explain the relationship between cost, production, volume, and revenue. This analysis can be expanded to show how the changes between fixed and changing cost relation will affect profit level and the BAP in, for instance, product prices or turnover. The break-even analysis is particularly useful when it is combined with partial budgeting technique, and the most important advantage to use this method is that it shows the minimum required amount of economic activity necessary to prevent potential losses. Furthermore, based on the break-even point formula, it is easy to make additional calculations that provide insights into the profitability of the investment. And next is the disadvantage. The disadvantage of the break-even pricing, which it have a poor quality data that would lead inaccurate conclusion. The regular changes in circumstances reduce its usefulness as a forecasting tool, as a break-even chart may be time-consuming to prepare. This break-even can only apply to a single product or single mixed product, so there will be a limit.
Profit pricing. The definition of target profit pricing is a method that involves identifying the price at which a product will be competitive in the marketplace, defining the desired profit to be made of the product, and computing the target cost for the product by subtracting the desired profit from the competitive market price. Characteristic. There are three characteristics. The price of the product is determined by market conditions. Second one is the company is the price taker rather than a price market. And the last one, the minimum required profit margin is already included in the target selling price. For the reason, the key objective of this strategy is to enable management to use proactive cost planning, cost management, and cost reduction practice where costs are planned and calculated early in the design and development cycle. Few steps in implementing the strategy. Started with conducting market research, then identify the nature of a market. Next, with translation of customers' requirement into product features, development of a product design, determine the price margin and cost, conducting value engineering process, improve the design and to reach target profit pricing, approval of top management, maintenance of accounts, and last but not least, implement the target profit pricing. For the sample calculation, we can refer to the slide. We talk about the advantages. It shows management commitment to process improvement and product innovation to gain competitive advantage. The customer feels more value is delivered. With the passage of time, the company's operation improved drastically. Disadvantages. There are two disadvantages. The first one, the design should be developed within a reasonable time frame. Besides that, if a proper design is not developed, it's better to shelve the project for a short time. Okay.
In conclusion, today's competitive market, it is so necessary to get abreast of any changes, however slight, in those markets and to price accordingly. Every cost that is being spent need to be put into consideration, because in order for your company to succeed, you must charge enough to cover your costs and earn at least a modest profit. Businesses must be constantly attentive to their opponents' actions in order to have the comparative advantage in the market. A firm's decisions on the price of a product and the pricing strategy implemented impacts on the consumer's decisions on whether or not to purchase the product. Most businesses are using this strategy to price their products and services. That's all from us. Thank you.